there are still companies we believe are selling at attractive prices for long-term investors. And when we're in an environment like now, what we tend to look for is companies that pay a decent dividend. So if we are vindicated in terms of our reasons for being wary, if we're getting paid a decent dividend, so if our timing's off, it's not such a big deal. And we believe that the stock that I'm going to mention in a moment is such a company. So our favorite idea is currently very much out of favor with investors, even though their earnings per share, their cash flow per share, and their dividends per share are up in the past 5 years. The stock price is down 70%. And according to Standard & Poor's Corporation, of the 24 analysts who follow the stock, only 6 have a buy rating on it, and 12 have a hold, which is code for sell, or an outright sell on it. Secondly, this company has an excellent track record of returning capital to investors because of their strong cash flow. The dividend yield is over 5%, and they've been buying back anywhere from 3 to 5% of their stock every year through their cash flow. This company is a leader in all of its markets. They play a critical role in the world's financial markets, and they've been in business since the 18th century, enjoying a credit rating of A+ by S&P and A3 by Moody's. So we believe it's a quality idea, and what it is, it's the New York Stock Exchange Euronext. It's a world leader for listings, trading in cash equities, basically stock market, and also in derivatives. They also distribute market data. They're also involved, obviously, with the IPO business. But 75% of their business is what we consider to be sort of exchanges. The revenue mix for the exchange business is nearly 50% is their European derivatives business. Another 21% is their stock market business in Europe, Amsterdam and Paris, and bourses like that. And those businesses, by the way, don't have much by the way of huge competition, unlike the rest of their businesses. 17% of their business is the New York Stock Exchange, and 15% is their options business in the U.S. The cost structure of the company is dominated by fixed costs, and the reason why the stock got to really, really lofty levels before the financial crisis was that volumes were increasing. Investors assumed that volumes would increase ad infinitum, and they bid the stock up to very lofty, silly levels. So their core business has been hampered by a challenging macro environment. Volumes have become weaker because lack of volatility is one thing. Another thing is a huge amount of competition has come into the marketplace. But their response has been very good. Their management team, we think, is world class. They've done a good job of removing costs. They've taken out $450 million in the past 3 years, and this is a company with $4.5 billion of revenues and $6 billion of market cap. They're integrating acquisitions well, and they're developing new products in response. They also have recently got their IPO mojo back. Hong Kong Exchange famously was the #1 IPO exchange for a few years there, and now this year it's back. But this is not a huge part of their business. It's only something like 7%. So sort of in summary, bottom line, we fully recognize there are headwinds, but the stock's cheapness, we would argue, 10 times the average earnings over the past 3 years, selling for less than book, they have decent financial strength, already reflects the bear case. The stock was the subject of a potential takeover a year and a half ago. It got into the low 40s. It's now in the low 20s. So we think that it's been beaten up pretty good. The company is at the forefront of an industry that's moving from a multi-line parochialism, was what we call it, to more of a multinational, multiple product model. And we believe that once we get past this period that we're in, that they're they're poised to take advantage of prosperity in this industry probably better than anyone over the next 5 to 10 years. And then the final thing is that we really think they're the good guys. They represent transparency. The financial crisis was all about lack of transparency, so we see them as being the anti-bank. They promote transparency. They're systemically important to our financial system infrastructure, but they were not anywhere close to even needing a bailout during the crisis because they have a toll-taker business model. So we believe they represent the light of day, and that they have it's a business that's been around for well over 200 years. They've been perceived, certainly since Glass-Steagall, as the advocate for the little guy, and which we believe is a lot of goodwill. And it's a business model that's enduring and that will be here. But I think as investors, we have an opportunity to buy into a world-class business cheaply and get paid 5% while we wait.